Okay, hello and welcome. I'm Matthew from Rosie and Rosie, investment property specialists helping you invest in property with confidence. Today we're joined by award-winning mortgage broker Thuy Nguyen. Thuy is the recipient of numerous customer service awards, the Better Business Industry Award for Community Engagement, and most recently the MFAA National Finance Business Broker Award for 6 or more loan writers. Welcome and thank you for joining us today.
Thank you Matthew.
It's the first Wednesday of the month, and yesterday, as they do every month, except in January, the RBA announced the cash rate. Today I wanted to talk to you about what was announced and what the banks have done in response. So, what can you tell us about yesterday's monetary policy decision?
So the good news, Matthew, is that the Reserve Bank has left rates unchanged, so it's still at 1.5% cash rate, and that's really good because it means that potentially banks won't increase their rates, won't move on that.
Yep.
As well.
They haven't changed for quite a while, August 2016?
Yes, since August 2016.
Tell us, why has it remained unchanged for so long, and when do you see this changing?
I don't have the crystal ball, but from reading the intel from the Reserve Bank is basically that they see that household debt has increased quite significantly, and they can't see wages moving up to that level either. So with that, plus other things like inflation and unemployment, they've decided that the cash rate should be left unchanged and see how things move forward from there. And coupled with other changes from the lending point of view, the credit squeeze, if you like to call it that, through the ASIC regulation and APRA regulation, which has seen some property prices in particular markets like Melbourne and Sydney slow down. So those changes have kind of worked in some extent, and because of that, the Reserve Bank felt the need to just leave the rates unchanged.
Yeah, so if it wasn't for those small changes, largely APRA have made, they would have otherwise increased the cash rate to slow down the price.
So if those other regulative changes didn't work, then we might have seen a different outcome yesterday.
Okay, great. And we're seeing commentary just recently around the ending of the interest-only period for a lot of people who had loans written or settled on loans 3, 4, 5 years ago, and the impact that those people, the impact that will happen with those people coming onto principal and interest rates.
Yep.
How do you see that impacting people, and what perhaps advice do you have for people who are in that situation?
Okay, so the government APRA, which is the governing body that overlooks bank conduct and lending, they've tried to do some soft changes to the credit market and obviously reduce or slow down the property market somewhat, and it's kind of worked. And one of those changes is with interest-only loans. So the new changes that's coming through the banking system is if you've currently got an interest-only loan and you've done your 5-year term, it's unlikely, or there has to be a really good reason for you to get another 5-year extension. If you can't get that extension, you have a choice to refinance to another bank and get another 5 years, or your loan will automatically go on to principal and interest. And when you pay principal and interest, you're now paying not just the cost of borrowing that money, which is the interest portion, you will also have to pay the principal, so essentially reducing the loan over time. And if that household, your household has taken up debt since you've first taken out your loan, and going to another bank is not an option because of the serviceability restrictions, then you'll be in a position where you will have to pay principal and interest, and that will be it's going to affect your cash flow really at the end of the day. So my tip for people is, if you have an interest-only loan and that's coming out of its 5-year term, or you're on a fixed loan, to be proactive, contact your broker, contact your advisor, and look what we can do. Let's put a plan together so that when you do go out of that interest-only term or the fixed term, at least you're going to land on your feet and know exactly what's going on, rather than being reactive and then get stressed and have a bit of a hit to your cash flow.
Yeah. Yeah, so a bit of a health check or a
Yeah.
review of your
Yes.
finances.
Definitely.
And how often should people be doing that?
Well, as a business here, Rise High, we review our clients every year, and I recommend at the very minimum have a review every year.
Mm-hmm.
And some clients we touch base as often as you need, but again, minimum 12 months.
12 months.
Or when your loan comes out of its interest-only period or fixed period, or change in lifestyle, change in your situation, marital change, just having children, career change, things like that. Anything when there's a change in your lifestyle that's going to affect your cash flow, your income, let us know about it so that we can help put a plan together for you. Yeah.
Thank you again for joining us today.
You're welcome.
I'm afraid that's all we've got time for.
Sure.
But before you go, Thuy, can you tell us how can people follow or get in contact with you?
Sure. My mobile is the best way to contact me, and the number is 0409 407 346, or by email, and I'm also on Facebook if you like to be up there.
Yep, and we'll put that information in the comments. Thank you again, Thuy. We certainly look forward to having you back with us. Thank you for joining us too. We hope you found Thuy's insights to be useful. If you have any questions for Thuy, I'm sure she would be only too happy to help if you got in touch. Similarly, if you have any questions or feedback for us, please send them in, comment below, or email hello@rosieandrosie.com.au. We'd love to hear from you. It's been a pleasure having you with us, but it's time for us to go. Until next time, I'm Matthew from Rosie and Rosie, helping you invest in property with confidence.